now. And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Good morning. Welcome to Financial Fitness Fridays. Today's show is all about joy. We're full of joy on the chat. We're full of joy here in the studio. My gosh, we're just beaming with happiness and rainbows this morning. How about you? Welcome, everybody. We're happy to see you. How joyful are you this morning, Deb?
Extremely.
Yeah, good.
Extremely joyful.
What I do every day, though, it's going to sound corny to everybody. Peace and love, love and peace. I do practice gratitude because I am grateful for a lot of things. I'm grateful for the people I work for. I'm grateful that I'm able to do what I do, where I do it, where we have clients' best interests in mind and no one tells us what to do, right? Client's agenda makes you sleep better at night. Got to be grateful for a lot of things, so just keep your perspective. And that comes to markets as well. Because as I meet with clients and the closer we get to the election, Danny, the more concerned and worried they are. And you have to be the one who places it all in perspective when it comes to markets, don't you?
Yeah, and I think it's difficult in this time, especially in this day of age of just, technology and communication that happens so quickly. Mm-hmm. And then, the narrative, and I think the difficult thing is what to believe anymore. And we have to remember, we have to separate a lot of things, right? We've had the RNC, we had the DNC that just closed last night, and a lot of narratives, a lot of rhetoric. And we've got to remember that most of it is just that. We hear about policies on either side and what the impact may or may not be, but it's still hypotheticals. None of this has actually been physically done. Without executive action, many of this will likely not be done, especially if you remain some type of gridlock between the House and the Senate.
You could promise everything you want, but the checks and balances are there. Markets love gridlock. We also have to remember that. So the presidential run is one thing, but remember, Congress is more important, in my opinion, anyway, and local races. So you got to keep in mind that if it's gridlock, markets will like it, very much so. Most important today, the real center of joy will be Mr. Powell in Jackson Hole and what he's going to look to do after that horrific revision to payrolls.
Which he knew about.
You would think so, but I was in this camp where I thought 25 basis points would be the place, but I don't know if maybe 50. The Fed funds futures right now is back to fully pricing 4 rate cuts by the end of this year. Wow. So you're going to have, if that's the case, a 50 basis point cut in one of these meetings. So we'll have to see what that's going to be. But obviously, that's where all eyes are after the conventions. That is going to be important. And this is what I also tell clients all the time. And people who are astute on the market and they don't let politics get ingrained into their portfolios and then take action that's going to cost them money, is the fact that interest rates matter. The Fed matters first. It's always about interest rates and where the Fed's going to go. That is the primary focus of markets. Listen, I could show you periods during the Great Depression, the market's done great and people living in tents because there was manipulation of the market. There was manipulation of the interest rate market where interest rates were kept at a certain level so farmland could be refinanced. I have a lot of great books that I bought that were written during the Great Depression along with magazines, and I go through and I look at these nuances and see how similar they are today and how the market had performed even though people were on breadlines. This is the counterintuitive nature of markets. Think about this, Danny, and I tell clients this and they don't realize it. When Trump was in, clean energy stocks were doing great. With Biden in, oil and gas stocks have done very well. You would absolutely think rationally they would be the complete opposite. So please.
Which rather counterintuitive, right?
So counterintuitive. So markets are designed to stump you. And you have to keep that in mind. So as we get toward the end of the year, yes, there will be sector rotation. Yes, you'll probably see more volatility. But that doesn't mean that you go ahead and blow everything up. And that's why you do have to keep perspective. You can have all the opinions you want about who you want to win. That's fine. But don't take it out on the money. How many times, Danny, have you gone through your career? If Obama wins, I'm taking my money out of the market. If Trump wins, I'm taking my money out of the market. If Biden wins, and we're like, no, I understand how you feel, but listen, you got to separate yourself. It's not easy. I'm
Every
not
major
saying
election.
it's easy. It's you got to be Switzerland neutral.
Yeah, I visited with somebody yesterday, and we were talking about, he's like, do I feel different than most people how I feel about these things? I'm like, I don't think so. No, I think that most people feel the same way, but it's actually putting it into action.
Yeah, it is.
And then we do need to take a step back. Say, okay, what is the reality of this all? We're getting so much negative information. We've interviewed in the past. We've talked to lots of different people that are, quote unquote, market, strategists, portfolio managers, and a lot of times they are very, very bearish at all times. You hear about Harry Dent calling for a 70% crash. Well, Harry Dent's been calling for a 70% crash every single year. At some point, he will be right, but.
And they'll drag him out when he's right, but he's consistently the same message.
Correct. And then the markets have a tendency to go up more than they go down. However, we do have to worry about the destruction of capital when they do go down and where you are in your life cycle. Because if we're in distribution mode, that's not very good. If you can play a little bit of defense and continue to contribute and put funds to work when things are down and you get that volatility, you can use this to your advantage.
Yeah, making a mark. He's on our chat, says, look at market returns to the presidencies. You'll actually find Democrat presidents have an edge up. It's really because of where Congress is at that point, too. Right? If it's a full sweep Republican, full sweep Democrat, I think you would have a problem. I think markets would then be really focused. But I think as long as you have gridlock, and it looks like we're going that way, then I don't think markets are really going to care. They're just going to look at the direction. This whole talk, and there's something, that we're talking about the unrealized gains.
Oh, man.
Taxing is absolutely the stupidest thing I have ever heard. If you want to level the playing field, in other words, you want to level everything, you will do that. But it can't happen. To Danny's point earlier, all these promises that could be made on both sides can't really happen.
That's a big one, and
that'll take down. That's when I'm not trying to be bombastic here, but if you are going to do that, you very well could go into a depression, because there is no incentive anymore for money to be made, and then you would have the mass liquidation of assets and jobs lost to pay taxes. That is one of the worst. I don't care who says it. That is one of the worst things I have ever heard that gets floated around.
Let's touch on that on the other side.
Okay, we'll touch on that. Also, I want to talk to you a little bit about a modern wealth survey. How does it feel? What is it? What's the perspective from Americans about feeling wealthy? What's the number? Even though I hate to focus on the number, I do think this is interesting when we get back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back. JP says it's an era of joy. I like that. Welcome to the era of joy. Yeah. Just mellow out for the rest of the show. Mellow out. Take it easy. No, but we were talking about unrealized gains and taxation on thereof. And that is, again, dumb decision. Dumb to talk about it. I know it riles up the tribalism, but if any side says it, it's stupid. I don't care who says it. I don't care if it's Republican or Democrat. That is a dangerous prospect for sure. But you wanted to expand a little bit on that, Danny.
Well, I think that, we got to think about what actually happens. And so a lot of policies that are thrown out are counterintuitive as well, where, one may be very inflationary, one may be deflationary. But at the end of the day, some of them have the same common goals and themes. Mm-hmm. And I think we can pick apart on either side, Trump or Kamala, as far as what their stances are and, good and bad. Now, I think there's some that are much better than others. But, from an economic perspective, if you start taxing, so imagine, and this is where the narrative, I think, gets off base, is that, many people, right now, they're currently saying, we're only going to tax unrealized gains on those with $100 million or more. Great. Okay. See how their donors like that, number one. But the impact of that, so you put this in the tax code, if you can actually get this passed, I don't think it'll be easy to do if they did.
I don't either.
But let's assume they did. What stops them from lowering that number, right?
No, you're right. It opens the door to something very dangerous. You have just let in the demon. If you've passed that for 100, you're starting out at 100 million. It's like when Obama said, well, what's rich? Now it's 250,000. That was the devil number. Now it's 400,000. But it's like you said, you're opening that door.
Well, and Biden actually floated this out a couple years ago. So this isn't something that's new.
No, I know.
But think about the impact for closely held businesses.
Yes.
Say mom and pop, a family business that's grown over time.
We deal with that and that illiquidity, right?
That's right. or people that
on
are
paper they have a lot of money,
That's
but
right.
they are not really worth much in liquidity.
Well, you look
Imagine
at
what you would have
farmers,
to do.
landowners, ranchers, people that may own a lot of land, but they may not be cash rich, right? They've got it stored in something else that is illiquid. And so basically it forces liquidation of these types of assets. And so that is where it's extremely negative in that aspect.
Mm-hmm.
And if they start with one area, they're likely going to move it down.
So, Danny,
further
let me
and
ask you a
further.
question. Say that happens and you're going to sell this closely held business in this scenario. Who the heck is going to buy it?
That's the problem, right? So who?
Because if I have appreciation on it now, in other words, you don't want to. If you want to take everybody down, this is a good way to do it. Because why? Who would buy this business? Who would buy anything? Who would buy a stock? Who would buy? I mean,
Well, you know who, but it wouldn't be at the price you want. It'd be either a major conglomerate, a big corporation, private
the
equity,
government, maybe.
or that was my next one, the government.
yeah, because you can't have that. And what if you lose money the next year? Do you write that off? Is it?
Yeah, how does that
unrealized-
work,
How
right?
does unrealized losses work?
So imagine in this housing market, say you had a house for $1 million, and if we're going to have a 25% unrealized capital gain on it, and it goes up to 1.1, you're going to be on the hook for $25,000. And the next year it may go down. So are you going to get that money back? How does that work? They're not going to give you a rebate for that.
Well, think about this.
A
When
refund.
you have losses on your portfolio and no gains, you can only write it off against $3,000 of ordinary income, right? So think about during the financial crisis.
Correct.
Your portfolio's down 50%, right? You have a certain amount of losses. You have no gains. The government's not going to say, well, you're hurting right now, everybody. You're losing your jobs. Maybe we'll give you a break and we'll allow you to write off all your losses against your ordinary income this year. Imagine. I mean, that would have been a way to help people make it through without selling assets at the very wrong time, because they just can't do it. When it comes to losses, you'll absorb the losses. They'll take your gains. That's how it'll work. So that's a dumb thing. So you thankfully for checks and balances, you don't make changes in the portfolio based on these kinds of crazy things that are going to be floated, whatever it is. So you gotta stay calm. You gotta take a joy injection. What's the joy injection for you? Is it a glass of wine? Is it some bourbon? I think for Danny, it's probably bourbon or whiskey. Sleep. Yeah, that's a good joy. Sleep right through the year.
Oh, man.
Knock yourself out, man. Right?
But these are the challenges that we are all faced with from an economic perspective. Where do we invest? What do we do? And I think we're going to have some time to figure this out as things materialize and we begin to see what's actually happening. And so even if the person maybe you don't like gets into office, things aren't going to just happen overnight. Executive actions on major items like that are not just going to happen. This is going to be something that is going to have to be passed through Congress.
It's just a continuation. Say if Kamala gets it, it's just a continuation of what Joe Biden did. So it's probably not as dramatic as everybody is thinking it's going to be.
Yeah, you would think. I mean,
right.
she's
It's probably just on the same path. So markets are good at not panicking over these things. So that's why you shouldn't either. So keep that in mind. So Charles Schwab today released findings on this 2024 Modern Wealth Survey. That's excluding anybody who's owned Charles Schwab stock for a couple of years. But this study is a little bit interesting because it looks at what is it to be considered wealthy? What's the number? Right? So boomers say a net worth of 2.8 million. Younger generations, millennials and Gen Z, are saying 2.3 million. Right? So all Americans, it's roughly 2.5 million. So that's the average net worth, Danny. It takes to be so-called wealthy. And if you break it out by geographics, right, you look at the geographical regions, California, San Francisco says average net worth to be wealthy, 4.4 million. Average net worth to be financially comfortable, 1.5 million. If you are in Houston, 2.3 million to be wealthy, Financially comfortable, 662,000. So it's just what I always find amazing about these is how do you get to that number as an individual? What is it? It's got to be emotional. It's got to be a little bit of joy. What number brings you joy and happiness?
But that number is so different for each and every person.
That's why you can't use that number to dictate your own life.
That's
And
right.
I just find this, to me, this is like clickbait. Like, I like to read this stuff because it's just interesting to me when you get these surveys about what it takes to be wealthy as far as average net worth.
Yeah.
You know?
Yeah, because it's so different for each and every person based on, expectations, objectives, goals. Lifestyle is really what it boils down to at the end of the day. So what does that mean to you? There may be somebody with $362,000 where that's great. They're still going to be able to do everything they've done and they've worked really hard to get there. And there may be somebody with $3.6 million that's not enough.
It's not enough. Yeah. How many clients do we deal with that have millions of dollars and they just spend so much like anybody else? And like, you have to keep it in perspective, and for someone that might even have 300 to 500,000, they've taken Social Security properly. They have a job. They work part-time. They have no debt. And those people are very happy. So that definition is very personal. So you can't benchmark against a survey like this. It gets out for the company that does it. It gets a lot of PR. Quite frankly, we're talking about it. A lot of other companies are talking about it. CNBC was talking about it. So it does create name recognition or advertising for the company that's doing the survey. But when the reason I bring it up, Danny, is something you just brought up. It's so personal to people. So people benchmark their portfolios against the S&P and other things. They also benchmark their number to others or some number they have in their head because they heard it on an advertisement. And you got to let, again, that stuff go because it's based on you, your lifestyle, your relationship to debt and savings. Overall, it's such, because people say, I got to figure out what my number is. And I'm like, well, there is no number. You got your own number, but this is based on a lot of things. You got to let all these predispositions sort of drop. And that's not easy, especially when surveys like this come out.
Well, and then trying to get to that number is a challenge because we see them and they're so far away from probably where we currently are today. And you're like, how in the world am I ever going to get there?
Yeah.
And, it's
right.
focusing
you could give
on...
up, right? You could give up.
You could give up.
If you see a survey like
you're
this...
screw it. This is too much. I'm never going to get there.
2.5 million.
Yeah.
Hey, kids, we're going out for dinner. We're going to eat at home, but yeah, you
Put the ramen back in the pantry.
Yeah. You just give up.
Yeah.
And that's where it's a clean slate for everybody overall.
But, so indexing, I think it's interesting because we always typically index to whatever the best index is at the moment. Lance and I talked about this, I think, on Wednesday. But the other thing I think that we index and we don't consciously know it, lifestyle.
Yes.
And it's usually to our friends, our peers. And that is where people get in trouble.
I think so, too.
Because you look around and we see people and you see...
Not my neighborhood.
Well, I mean, you see it all over the place.
But in a lot of, I see it in wealthier neighborhoods in Houston. Like you can tell who talked to who in the neighborhood by the cars they're driving.
No.
And all the other stuff like keeping up with your neighbor. I despise that. I cannot stand that.
I'll tell you what. We live in a nice neighborhood. It's not super fancy. It's not bad. It's pretty nice. And then there's another neighborhood that's probably lower income housing. And I guarantee you that neighborhood has nicer cars than where we live.
I love the trailers that have all those fancy cars outside.
Oh, man.
You're spending the money the right way. Because you know why? That purchase is doing what? Bringing you joy.
I could live in a trailer.
We'll be here. We'll be right back at WJOY. Stay tuned.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You have to love Texans, and you have to love Texans back in the 70s because we didn't really know better. You take a big propane tank and you stick it in the back of your truck and make the connection to your car so that you have propane-fueled engines because propane was cheaper than gas.
The Real Investment Show podcast.
Gas was almost $1 a gallon. It was outrageous.
Same show, your schedule.
You were a mobile bomb, but
at realinvestmentadvice.com.
But you didn't have to pay for gas.
Oh, man.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
It's the Lance and Larry show on the chat. Boom, boom, boom. It's like Rock'em Sock'em Robots. Boom, boom, boom. And Marie's the referee. Listen, guys. Joy and love. Love and joy. That's Marie.
Yeah, it's all in good banter, though, going back and forth.
It's good stuff, though.
Yeah.
Because deflationary, if you go back to the depression, because they're talking about inflation versus deflation, you don't want deflation. If you have deflation, something onerous and disgusting is going on, like taxes on unrealized gains.
Well, I think people want deflation right now because of the enormous amount of inflation that we just saw.
Well, I think they're meaning like more reasonable prices. Yeah. But if you have a deflationary spiral, and Irving Fisher wrote a lot about this, there is something tragically broken in your overall economy. That's what I think would happen again if you had taxes on unrealized gains. You would have a deflationary spiral that would lead to depression. So,
and keep in mind, Obama was really the king of this, right? He would throw something out there that was just so far off the wall, and everybody'd be like, economically, and everybody's like, "Oh my gosh, what in the world? And then he got done what he probably wanted to get
looks
done.
Sort of centrist.
Yeah, right. But he got done what he probably wanted to get done all along.
Yes.
But it made everybody feel like, whew, we dodged a bullet. Not so bad. Okay.
Yep.
And so it's those types of things that typically occur. And you got to realize they're pandering to certain bases and trying to get votes, especially right now. But that will happen again. But the deflationary aspect, I do think it's interesting in the perspective that this last bout of inflation was so much different than any really major inflation we've seen in the past, right?
It was the velocity of the change.
Not just the delta there, but it was also, it was a lot of that was the cause and effect.
Yes.
Because, you go back to 70s and 80s.
Yeah, I mean, in some way, this was a really self-induced based on dumb decisions. That hurts more than anything else when I pay these prices.
But it wasn't like the economy was super hot. Things just were running. Wage growth was continuing to run with it.
It was a great time, right? Like prices are rises. And listen, if you're in the stock market, you want a little inflation. Companies do need pricing power, right? You just don't want to be, going to the store going, oh my God, look at that.
And I think that's why people welcome the deflation.
I think they mixed up deflation with price cut, like in a way, right?
Yeah.
Like you're saying. That's true.
Yeah,
like, because deflation sounds good because it means my inflation's going away. Like I'm overweight and I lost weight, right? As opposed to I'm now a skeleton.
Well, and inflation is not all that bad as long as wage growth is continuing to creep up with it. But we saw nothing of the sort. I mean, 4 years ago, the average family of four was making $78,000. Today, they're making $74,000.
That's right.
And prices have gone up exponentially.
Yep.
That is not good.
It's right. It's all about the wages, right? If my wages are keeping up, whether if it's inflation at 9 or 10%, who cares? I mean, I'm not going to be happy about it, but at least I'm keeping up. So listen, everybody talks about a recession. And, there's a recession coming. We're in recession now. There is no recession. I mean, listen, pick your poison, pick your camp. Everybody's got an opinion. But what if in your household you acted like there was a recession just right around the corner? In other words, recession will come. Someone might lose a job. First of all, I think you have to do, Danny, is you have to define recession in your household. What does that mean? The economy could be gangbusters, but somebody is ill.
Yeah.
That to me is a household recession. I lost my job. I didn't get my bonus. Right? The world around me looks fine, but my world is a little upsetting right now. I'm going through a life change, a divorce, whatever it is. How do you prepare for that recession that can hit you and not your neighbor? And that was the gist of talking about this, Danny. Like, what do you need to do just to be a good steward of your household finances? And we talked about this first one early on, like before the pandemic. Because what spurred this for me is, I don't know if it was you, I think it was Lance and John. And Lance was talking about 1 year's worth of living expenses in cash, that 3 to 6 months is the rule. But we do take it further here because we talk about the financial vulnerability cushion. We talk about 2 years of living expenses in cash. 2 years, not 1 year, not 6 months, but 2. That 1 year one that Lance talks about, my AC breaks down. I have to fix my automobile. Year 2, something has happened. There's a recession in my household. I've lost a job. I got a pay cut.
And
there's
the AC
an illness.
broke down again in your car or whatever else.
Right, but I'm already prepared for that. I need to get that other step. Do you know, Danny, when we started talking about this before the pandemic, I had gotten calls during the pandemic from people that lost their jobs.
Yeah.
And they said, you know what? You all talked about this and we thought it was great. We did it. We are so thankful we did the 2 years worth of living expenses in cash.
I remember when we first started talking about the financial vulnerability cushion is kind of what we coined it as.
Yes.
People were like, you guys are nuts. Why would you ever want that much aside? And, not knowing the pandemic was on the horizon, just looking at markets, what had been going on, and, studying the impact of overall distributions and what happens when somebody does lose a job and you're still working age. You lose human capital for a small period of time.
Or say it's the financial crisis, right?
Yeah.
You're tapping retirement funds for a year, right?
That's right. And so that is where I think it's extremely important to begin to think about, okay, in your household, and it's different for everybody. It can be industry specific, job specific as well.
Yeah.
This is where I think, the rules of thumb are good, but
Yes.
we need to say, okay, if you're a professor who's tenured, all right, well, maybe you don't need as much, right? You've got
Or you
that
have a pension
guaranteed
coming in, right?
gig.
You have a guaranteed income.
Correct.
Right.
But if you're living on commissions, paycheck to paycheck, or whatever it may be, or an industry that's very volatile,
Yeah,
or
you're
there's
in the
potential
chat and
contraction.
Lance is beating you up and you got to
Yeah.
go to the hospital. You got to be out of work for a while. Right. So it is different for everybody based on their overall situation. But I still say that having a more than you think you need in a cushion is not a bad thing, especially where valuations are right now in markets. I think that when you look at Robert Schiller's, look at the Cape. I know this is boring. Nobody hates this.
We'll explain the Cape.
Well, it's a cyclically adjusted price
Earnings.
Yeah, price earnings. So it's really looking at real earnings over a cycle. And it's valuations. It's math. And no one cares about it when we're all feeling joy
And
in the stock market.
it is extremely accurate, but over a long period of time.
Over a long period of time. So there's an article in the journal that's pretty interesting. And it says, Robert Schiller's cyclically adjusted price earnings ratio is now more expensive than it has been 97% of the time since 1880. So the money manager, AQR, and they do this a lot. They look at real stock returns over 10 years following a 90th decile reading. Those returns have averaged just 0.5%. This is exactly why we forward adjust returns on asset classes in our plans when valuations hit a certain level. So if you look at, say, for example, 10-year Treasury yields now at, say, 3.86 or so, minus expected inflation over the next decade, that comes to 1.65%. In other words, if I am in distribution mode over the next 10 years and my returns are muted, then I may not be able to take 4% every year out of my portfolio, like the rules tell me. We prepare people for this up front, depending on valuations. But that also means that if markets are giving me poor returns, those people that use the stock market as a gauge of their net worth might get really discouraged. And having more money in cash at this point is not a bad idea. And that's where this financial vulnerability cushion comes into play. Also, you got to look at your debt to household income ratio. Not what the banks tell you. Oh, you need X percent, to pay a mortgage. No. Do you think they do these ratios at banks to help you or help them? Right? When someone says, "Hey, how do you think the IRS is going to rule on this thing?" I'm like, "Well, first of all, what do you think?" Well, they're looking at, A or B. Okay, don't even tell me. But is A better for you or is B better for you? Well, B's better for me. Well, they're going with A. I don't even have to look at it. They're going with A. So managing your household debt, Danny, don't you think? That is also important. That also allowed you to feed that financial vulnerability cushion.
Yeah, it's extremely important. So understanding the cash flow that you need and require to meet that debt requirement is a big challenge for many. And because, it's like we want to go buy a home. Hey, I want a home for $350,000. What's the first home you see, or maybe the second home? It's $450,000. Oh yeah, you can make this work. And so, it's very easy to think that we need something that we typically don't. And we can all say that. I mean, every one of us is guilty of that. And that's okay. You should be able to have those pleasures and be able to do that as long as you're within those guardrails.
Absolutely.
And you do it responsibly. If you can go buy a private jet, great, go for it.
That would bring me a lot of joy, Danny.
Bring you a lot of joy.
I get a lot of joy out of a jet.
Where would you go?
I don't know. I don't know, probably to HEB. or Walmart.
Now, that'd be something to see.
Pull your jet into the lot. We'll be back at WJ. Oh, what? I'm kidding, Russell. I'm kidding. I don't want to. Don't get crazy. Russell's the producer over there. I love our station. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Well, we're back. Talking about joy in your household in case there's a recession.
Which is interesting because I think it will bring some people joy just from listening to the chat. They're like, I can't wait.
Well, if you're listening to Adam Taggart, you might be.
You know, sometimes that is a self-fulfilling prophecy.
I know it is. Well, animal spirits are very important in markets, right? You're having a bet, you lose your job, you talk to your neighbor, you go, maybe we shouldn't go out to eat as much. Listen, animal spirits, the stuff you can't wrap math around, is very important to markets. Look at the emotions that circle markets in the short term, right? You can't ignore the narratives. You cannot ignore animal spirits. Stocks could be cheap as hell, and nobody wants them. Remember the Business Week article, the Business Week cover from 1982, The Death of Equities?
Oh, yeah. But you can almost see that every decade.
I had that in high school. I had the copy of that. I wish I would have kept it. And I'm like, oh, my God, yeah, this stock market, because they're talking about in business about the stock market. I'm like, why would I invest in the stock market? Look at this. Look at this. It's debt. Like the stocks haven't performed in, since I'm born. Right? I mean, and look what happened. So valuations were like 7 times earnings and nobody wanted stocks, right? Now we're at a cape of what, 32, 33, whatever it is, and everybody wants them. The demand for the product is very strong in certain periods of time. So you can't ignore that. So you're going to have create this animal spirit in your household. Paying off debt gives me a lot of positive animal spirits. It gives me joy in my household. Not having to have a debt over my head is very important, and you need to do that. The next thing you got to do is listen to moderate your portfolio risk. You might be feeling really comfortable taking on a lot of risk and displace what you really feel about risk because everybody's doing it, right? I'm missing out. Don't fall for that either, right? If you have to say sell your stocks at the very wrong time because something's happened in your household, that's a problem, right? So to moderate your risk, right, to fit back into your risk allocation, or at least like you feel that, hey, I've got my 2 years of living expenses. I know I won't need to touch this, but for the most part, many people are not doing that. They're trying to juggle all these financial goals at one time. So if you're taking on a lot of risk and you have a lot of illiquidity, then you might want to change that just in case.
Well, you may want to begin to think about where you're putting funds as well.
Yes. You mean when you're directing them right up front. Yep.
You and I were talking about an article yesterday. A politician, took money out of his 401k essentially to pay for his daughter's tuition. Noble, I suppose.
Yeah.
But if it's going to defeat the purpose of you retiring, I don't know.
Yeah. There are a lot of people who will do that too. They'll take money out of their IRAs, pay penalties and taxes to help their children through school.
But you also see that during recessionary periods where that's the only thing they can tap because
remember during the financial crisis, right? People that's where they had all their money.
That's right.
So they were taking out money, getting penalized and taxed. It was like a death. One client at that time said, I'm in a money death spiral.
You remember they even did that during COVID where they allowed you to take, I can't remember, was it $30,000 or $50,000 you could take out and repay it back within 3 years? Yeah. Mm-hmm. And so that is where we get into trouble, is that we're beginning to take from one thing for something else, and that's not the purpose that it was intended for. And so if we can begin to think we're in accumulation mode, where are we putting those funds? We talk about that hierarchy of saving often, but I think it's extremely important to understand that we put the cart before the horse so many times that we're not building that emergency fund or the financial vulnerability cushion, and we're only looking at socking everything into the 401k. That's great. And listen, I think it's the thing to do is you want to, because we want to make sure you get that match and don't leave free money on the table. But if you're younger, I would certainly get that savings up. And I know I'm going to hear it in the comments here that, nobody can save. I can't save. Things are too expensive. And I get it. It's difficult.
Danny, how many people do you know, right? They're told, like younger people too, put all your money in the 401k.
Yep.
They suck all their money away. In other words, we would rather you do up to the match and start building up your savings cushion. Don't worry about the retirement part. If you don't have the hierarchy in place, like you said, the foundation of that hierarchy, I think is a couple of things, but most important is liquid savings outside of your 401k. And then I hate the fact how the financial industry will say, well, that's what the Roth is for. You can tap the Roth. We don't want to tap the Roth. Even though it's after-tax dollars and you can take those contributions. You don't want to tap the Roth if that is money for retirement. But the Roth is not a savings account, which is a lot of times I read in financial press, drives me nuts. That doesn't bring me joy to read that. No joy there. Now I want an Almond Joy.
It took you this long of saying joy for that to kind of resonate in your head. Maybe that was like subconsciously what you're thinking about.
That's what I was thinking about. I was thinking about candy this morning. Chocolate.
Almond Joys.
Almond Joy. No, but I think you're right, Danny. I think that having the way we do things or help people with the hierarchy as opposed to what you hear in the press about, oh my gosh, just put everything, this 401k is this unicorn. It's amazing. It's the best thing. It'll bring you so much joy. And it doesn't. That unicorn horn is going whoop right where you don't want it. You've got to have some money aside in after-tax account.
Well,
right?
You do. And if you're saying, look, I can't put a lot away, well, great. That's okay.
It's okay.
Put a little bit, because what happens over time, and we've talked about this with credit cards, right? You break a rule and you're like, you know what? I'm just going to go buy it. I'll put it on the card. And we've broken our rule that, hey, I don't have the cash for it, but I'm going to go ahead and do it. It's something I wanted, not needed. And then what happens? then you begin to say, oh, it's easy. I'll go ahead. We can do a little bit more. Oh, we can do this. But it's the same thing with savings, is that once you see that account start to build, it starts to feel pretty good. You're like, oh, okay, I can do this.
And then maybe you flex your muscle and increase it a little bit, right?
Yeah. That's what I see over and over again is that, people begin to start feeling good about it. And, I don't know if it gets endorphins going or, the psychological impact, but there is something there.
There is. You have control over it, right?
Yeah.
Yeah.
And I think that's a big thing. You're taking control of your future, and it feels good because, you're like, all right, little by little, we're going to chip away at this. And that's where I think those big numbers we were talking about earlier they can be a negative.
They can be. They can be. That's why I brought it up, is just that it's great fodder. It's great for the company producing the study, but it could actually be detrimental to you. Danny got the gist of what I was trying to do. Now, what also you need to do if you think you want to prepare for a recession in your own household, you've got to keep your human capital skills fresh. You always have to be learning. There are so many courses available out there for free. Hone your skills, your computer skills, whatever it is that you think you're going to need to succeed and stand out, to not only enhance your job security, but for your ability to move on. The biggest area of the greatest wealth, people will say, is two areas: your home and Social Security, what you've built up over time. No, it's you, your earning power, your human capital skill. And if my skills are sharp as a blade, then I won't be unemployed for long, or the company that I'm with will do everything to keep me. So you have to always be learning and not be complacent. And I think that that's really important.
Well, I think that's why, while you're working, you're building your human capital, you continue to pour into yourself in the sense of, do you go get another certification? Do you do something else to continuously learn and become an expert in your industry? That is where you build that wealth over time, investing in yourself. And, we talk about this too. You invest in your health. I mean, only one Almond Joy, not many. Right?
Half a joy.
Half of one, half a joy. It's going to be a quarter joy today. What's Powell going to do?
Well, they come two separately, right? So you only have one of those joy bars.
I can honestly say I don't think I've ever bought one. Maybe never had one. I had to change that.
What? You never had one?
I can't recall. I don't eat much
I don't
candy.
either. I'm not a big fan of like coconut and nuts together, like regular almonds. I'm not a big fan of that whole thing. I was always a Three Musketeers Milky Way guy, but not an Almond Joy guy.
Huh. I wonder if that's geographical.
Sometimes you feel like a nut, sometimes you don't. He's not going to get that. It's way before his time.
Oh, I know that.
You know that?
Oh, yeah.
Okay.
Oh, yeah.
Yeah. So these are things: financial vulnerability cushion, managing your debt, paying it off, moderate your portfolio risk, new human capital skills, or honing the skills you already have. You also have to recognize that you have these skills, Danny. Sometimes people don't realize, like, it takes an outsider, maybe a spouse or someone to say, you're really good at this. And you're like, what? I didn't realize I'm good at this. Sometimes you do need someone to step outside because you're so close to it and say, I think you would be really good at doing this. And that happens a lot.
Yeah, and I think that builds that confidence up to continue to do so. And when your spouse especially finds pride in what you're doing, you're doing something good for your family, for your long-term future.
Yep,
that's extremely important. And man, what a good feeling to have when you're, everybody likes a little bit of pat on the back, right?
Absolutely. And that brings us to the end of our show. And joy for your weekend. Lots of joy. Now, around Sunday night, the joy starts to dry up like an old prune. But joy, at least for tomorrow, right? Do that for us. Lance back on Monday. Check out our newsletter, Retirement Blueprint. We're going to have a workshop coming up in the Woodlands. You want to know the soup to nuts about how to retire. You're a pre-retiree. You need to join us. Sign up at realinvestmentadvice.com. You all take care, everyone.